Welcome to the Explainer. You know how sometimes you see a company report these huge profits, but then its stock price just tanks? Well, today we're going to pull back the curtain on why that headline profit number can be a bit of a story, and how you can find the real truth by following one simple thing: the cash.
And let's just kick things off with a little warning from one of the greatest investors ever. Warren Buffett is basically telling us, straight up, that the earnings you hear about can be, well, let's say, polished. So that sets up the big question for us today. If reported profits can be an illusion, how do we figure out what's actually real?
And that leads us right into our first section, the earnings illusion. We're going to dive in and see exactly why that big flashy profit number you see on the news can sometimes be more fiction than fact.
Check this out. This is a perfect example, and it's from Buffett's own company. In 2018, Berkshire Hathaway's actual businesses were crushing it, generating a massive $24.8 billion in profit. But the official earnings number they had to report? Just $4 billion. I mean, how is that even possible? What happened to the other $20 billion?
So what gives? Well, the answer is all this accounting noise that gets in the way of the real picture. See, accounting rules force Berkshire to report a loss on some of their investments on paper, even though they hadn't actually sold them or lost a single dollar in real life. It was just a temporary dip in the market. This is exactly why the smartest investors learn to ignore that noise and just follow the cash.
So this is where we find our secret weapon for cutting through all that noise: the cash flow statement. This document doesn't care about accounting theories or paper losses. It only tracks one thing: cold, hard cash.
And you know what? The idea is refreshingly simple. Unlike earnings, which gets all tangled up in complicated rules and estimates, cash flow is just what actually happened in the company's bank account. Money in, money out. That's it. And that simplicity is what makes it so powerful and so much harder to manipulate. And this slide right here is a classic example. Back in 2014, Amazon reported a net loss. The headlines all said it was losing money. But if you ignored the headlines and looked at its cash flow, you'd see a totally different story. The company was a cash-generating rocket ship, pulling in almost $6 billion. They weren't failing. They were just investing every penny back into future growth. That's a truth only the cash flow statement could tell you. So, where does all this amazing cash information live? It's all organized really neatly for us on the cash flow statement, and it's broken down into three main sections. Think of them like three big buckets we need to look inside to really understand the whole story.
So these are our three buckets: operations, investing, and financing. Together, they tell a complete story. Operations tells you if the main business is healthy. Investing shows you what its plans are for the future. And financing reveals how it's paying for everything.
First up, and this is the most important one, is cash from operations, or CFO. This is the engine room of the whole company. It answers one simple question: does the main business, selling its products or services, actually bring in cash? For any healthy company, this number has to be strong and growing. It's an absolute non-negotiable.
Next, we have cash from investing. And here's the funny thing. A negative number here is often a really good sign. I know, it sounds weird, but think of it like a farmer buying more land and better seeds. A negative number here just means the company is spending money to grow, building new factories, buying better technology. It's the cost of building a bigger future.
And our final bucket, cash from financing, is all about the company's relationship with its owners and its lenders. Is it raising money by taking on debt or selling more stock? Or is it so financially strong that it's actually paying back its debt and rewarding shareholders with dividends and stock buybacks? This tells you if the company is in fundraising mode or payback mode.
Okay, now that we understand the three buckets, we can put them together to find the one metric that professional analysts and savvy investors absolutely love. This is the number that gives you the clearest, most honest picture of a company's true profitability.
And that brings us to the holy grail: free cash flow. The idea is actually really simple. You start with all that cash the main business generated. Then you subtract the money the company had to spend just to maintain and grow itself. Stuff like new machinery and buildings. That spending is called capital expenditures.
And whatever's left over, that's the prize. That's the surplus cash, the actual profit the company has after all the necessary bills and investments are paid for. This is the money that's truly free to be used for things like paying down debt, buying another company, or, my personal favorite, rewarding shareholders. This, not net income, is the true bottom line.
Okay, theory is great, but let's make this really sink in. We're going to look at two hypothetical companies that on the surface look like identical twins, but by using our new cash flow superpowers, we'll see they are worlds apart.
All right, here we have Plain Bagel Co. and Sesame Sands. Now look at that top line. They both reported the exact same net income of $10 million. So they're equally good investments, right? Wrong. Let's look closer. Plain Bagel is a cash machine, funding its own growth and returning cash to owners. But Sesame Sands? Oof. Weak cash from its business, and look, it's taking on debt just to stay in the game.
And that is the punchline. The earnings number told us they were equals, but the cash flow statement reveals the absolute truth. Plain Bagel Co. is a self-sustaining, healthy business. Sesame Sands is basically funding its existence with borrowed money. It's not even a close call.
So we've pretty clearly established that cash is king. To bring it all home, let's distill everything we've talked about into a simple, powerful checklist you can use anytime you're analyzing a company.
So here's your checklist. First, always compare cash from operations to net income. You want to see that cash number be higher. That's a great sign of quality. Second, find the free cash flow. Is it positive? Is it growing? That's what you want. Third, peek at the financing section. Is the company constantly taking on debt just to fund itself? That can be a red flag. And finally, always look at the trend over a few years. One good year is nice, but consistency is everything.
And that really brings us to the key takeaway. The income statement tells a story. The cash flow statement tells you the facts. It's the ultimate reality check for any business. So the final question is really for you. Next time you look at a company, are you going to settle for the story or are you going to count the cash?